This month, we decided to remove our overweight to European equity, moving to neutral position. We note that performance has been solid overall, given a rise in bond yields and also good numbers from hedge funds. Events in Italy, though, have escalated to the point that we considered it prudent to move to a more neutral stance and to continue to keep a watching brief on developments here. Italy's share in the equity market is on the small side, but it contributes about 1/3 of overall euro debt issuance, which is obviously very significant indeed. Furthermore, with the outlook for a political resolution now extremely difficult to forecast, we prefer to wait for more clarity. This may be some months away. Looking at the underlying fundamentals of global equity markets, Europe still looks to be the most interesting from the point of view of valuations. It is trading below other major markets on a price to earnings ratio, despite also delivering reasonable sets of earnings throughout Q1. We are of the view that the PMIs point to a strong underlying economy and to be able to sustain earnings growth in line with or possibly even ahead of market expectations. The rise in US yields has been interrupted by the flight to quality in the days after the Italian efforts to form a government in fact collapsed. At the same time, market expectations for further Fed hikes have softened just a bit. This is not entirely in line with the underlying pace of improvement still being witnessed in the US economy, and the expectation remains that the gradual drift higher in US yields will resume. It will take quite a serious shock for the global economy to move the Fed to alter its course at this point. In the midst of all this, EM debt has had a poor start to 2018 by its own high standards, down almost 2% year to date. The headwinds of a stronger dollar and higher rates will remain for at least some time, but the underlying credit quality is not a concern to us at this point, certainly not from the point of view of our coverage universe. We reiterate our view that the best place to be in credit bonds right now is at the shorter dated end of the spectrum.